Let me ask you about auto ancillaries, because that's a space which a lot of mid-cap stock pickers look at closely.
Right.
I think you made a successful investment in ZF Steerings,
right,
if I'm not mistaken. Do you still find value and opportunities in that space?
Yes. We currently own 2 stocks here. And yeah, so there is still squirm room, I'd use. It isn't an sort of an open field where you can just go and shoot a goal, but there is still room to participate. And I think the point to amplify here would be, again, saying we like to look beyond a little obvious cheapness, which essentially is saying look beyond time on near-term numbers. So I have this thought on saying that, yeah, like everyone would want to buy a Marico at 15 times, and so if you push it to someone even at 20 times, they would like to buy and say, hey, this is at 40 times, which everyone can see essentially. So how are we going to play this game, participate in it, and make appropriate money for clients? So similarly on auto part companies, I think that is the challenge. We have a weaker domestic growth scenario backdrop. We're coming out of it, whether it's trucks, cars, or two-wheelers, and these companies are dependent on as suppliers to the auto OE companies, and in the end, the consumer sort of confidence in buying bikes or whatever. So we'll have to go very, very sort of stock specific and search out these names.
So your bets are domestic plays or global plays?
Very, very domestic plays, largely or only sort of domestic plays that I can think on these names. So,
okay.
So one of the names we own, it is like a indirect trade that we've done. We also had a discount there, so it makes it more special situation like, which is a company called Phoenix Lamps.
Okay.
So we bought this quite some time back, and the idea was that we like Suprajit Engineering of Bangalore. And Suprajit has acquired this company. This stock traded essentially as a tracker, 10% discount. So it met some of that the pain which you had on paying up an aggressive 18-20 times for Suprajit by basically buying this at 10, 12, 15% cheaper. Okay. So we are talking about basically this stock being in the 110, 120 handle, and Suprajit being 140, 150. And so you were getting in this at arguably 135 for a 150 Suprajit, let's say. Now from there, Suprajit has done very interesting things over the last 18 months of our ownership, or nearly 2 years of our ownership, where Suprajit is moved as a stock to sort of 200, 220 odd. And we've got that additional comfort of valuation discount to what we paid up for Suprajit. Now, as you know, Suprajit is largely a domestic play. Their cables business, and they're built on that, and they bought this finished product kind of company they want to buy, which is a lamp which goes into both 2- and 4-wheelers, and that is their sort of plank off into the international markets, which they get a bit of that. And then they recently, about 3 months back, have done another international acquisition in the US, which is a very interesting thing, which is they've just used their cash well. The cash was earning 4% post-tax returns, and the acquisition, I think, earns them easily 10-12%, almost kind of dollar returns. So if you see that going to what our sort of investment philosophy is on good quality businesses and people who allocate capital well, it seems Mr. Ajit Rai checks those boxes very well, and so we own that name.
And the other stock that you own
and the other one we've recently bought into is Minda Corp. Again, on the same lines, if you see their 5-7 year numbers, they've done decent sort of growth. Their presence is both across two-wheelers and four-wheelers. They're trying to add more related adjacent sort of product categories to grow their business. They have an international presence as well, and it makes it again an interesting play, planking off of the growth of the local market, and then hoping that these guys can actually successfully roll out a similar thing that they're doing in emerging Asian countries, such as large countries such as Thailand, Indonesia, etc.
What about pharmaceuticals? I know it's out of favor for the last couple of years now, but do you find valuations interesting now in the mid-cap pharmaceutical space which you can look at, or are things moving too fast in the US FDA space for you to take a call on that one right now?
I would concur with you. I think you know, the risks are not very clear, and it's very newsy. And in terms of our you know, our sort of limited resources, our ability to you know, triangulate and get a view out on that has its own challenges, to be very honest. So I think on these kind of binary trades, if you get affected by US FDA visits or letters, etc., especially the bigger names which you're reading, you're just a news taker. You're basically not in a position to be able to, you know, differentiate the lot. So that is a challenge. And I think the mid-cap space, more interestingly, is the domestic kind of companies, very small, some of them, but we don't own any names there. Our hope was that we are trying to buy some of these chemical companies as a via media, and they were at a discount to you know, the API suppliers on the pharmaceutical side. So ultimately, you know, sort of money being fungible and names you know, being, you know, capital generating businesses, you know, cash flow generating entities, whether it's pharma or you know, or specialty chem, we don't particularly wear any badges, so to speak. So we've chosen to buy into these, and it's mixed, as we talked about. So if you see pharma opportunities emerge, we would look at some of these slightly smaller names. But I would say at the high level, valuations are very interesting, in fact, especially for, say, the biggest boy, Sun Pharma, and then going down to, you know, some of the mid-sized companies.
What about financials? I mean, how do you break up that big space for especially a mid-sized investor like you? I mean, do you stay with the big boys? Do you look at mispricing in some of the hated names? Or how do you approach that space?
Right. So, like here and now, in the last 2 years, we've entered in where it's been it's been a complete bull charge. And you know, it's been scary to put in your hand there because you have the feeling that you may get burnt. You know, whether the 4-time book will rest at 4.5 or will come off, you know, to 3, and then that's where you have a 30% decline on housing finance companies or microfinance companies, etc. So one of the names we want to choose to own has been the credit rating company, which is CARE Ratings, playing into, you know, essentially bond issuance through economic recovery as a good way to participate in that way. But like a advisory company or a consulting firm, you are not fighting for margins there. It's a much higher margin, much more robust business, and you know, you've been sanctioned as 5-7 agencies which are licensed to actually issue those ratings. So it's a good business to own.
And still a nascent business, you would say, in India?
I would think so. Yeah. I would think so. And then the other one we've looked at more closely, have not pulled the trigger, is the emerging new companies, you know, such as Equitas, Ujjivan Financial, new IPOs which have come in. And the bigger view that is getting formed is that there are pieces of the financial services market, clearly one big standout at 50% of consumer loan, which is mortgages, is one big piece which stands out, and that's been done enough. So there is this personal lending, credit cards, unsecured lending, etc., which companies are putting together. So whether it's RBL Bank or it's some of these is what we are looking at closely, but we haven't you know, owned any of these names. I think the valuations are a little aggressive, to say the least.
Ayaz, pleasure talking to you and good meeting you after so many years. I wish you all the best for your fund.
Thank you very much again.
Thank you.
Thanks.